Disclaimer.
Something extraordinary happened overnight on December 27th, 2025, while most of us were sleeping off our Christmas dinners. Silver, that quiet metal your grandfather might have stashed in a safe somewhere, jumped 10.2% in a single trading session to hit $79.31 per ounce. Now, if you're thinking that sounds dramatic, but maybe not earth-shattering, let me put this in perspective. That single-day move triggered automatic risk alerts across every major bank's trading desk in New York, London, and Hong Kong. The metal didn't just climb, it exploded through every resistance level that traders had marked on their charts, acting less like a commodity and more like a bottle rocket someone just lit. Here's what should grab our attention. When precious metals move this violently, this fast, it's not speculation driving the action. It's panic. But panic about what? The answer lies exactly 4 days away from that price spike, on January 1st, 2026, when China implements export controls that will fundamentally reshape the global silver market. We're not talking about modest policy adjustments or bureaucratic red tape. According to official Chinese customs documentation, any company wanting to export silver from China after New Year's Day will need to prove they can produce at least 80 tons annually and maintain credit lines of $30 million or more. Think about those numbers for a moment. The Chinese government just erected a wall that will block somewhere between 60% and 70% of the world's silver supply from reaching international markets. You know what the last time we saw a commodity supply shock of this magnitude? The 1970s oil embargo, when OPEC turned off the taps and Americans sat in line for hours just to fill their gas tanks. But here's the difference. Everyone could see the oil crisis coming. Gas stations ran dry, prices jumped at the pump, and the evening news showed the lines stretching down suburban streets. This silver crisis is happening in the shadows of our financial system, and most people have no idea the fuse has already been lit. Let me walk you through what's really happening in the physical silver market right now, because the disconnect between paper prices and actual metal has become almost comical. The COMEX, which is essentially the central marketplace where silver futures trade in our country, has seen its inventories collapse by 70% since 2020. That's not a gradual decline. That's a systematic draining of available supply. Meanwhile, if you actually tried to buy physical silver from a dealer today, you're looking at delivery delays of 3 weeks or more. 3 weeks. For a commodity that's supposedly sitting in vaults waiting to be sold. And those premiums over spot price. Dealers are charging $8 to $12 per ounce above the official market price just to get your hands on actual metal. Think about what that means. If silver is trading at $79 on the screen, you're paying up to $91 for a physical ounce. That's like going to buy a car listed at $30,000 and the dealer telling you it'll actually cost $35,000 because, well, cars are really hard to get right now, except in the car market, that would make headlines. In the silver market, it's just another Friday. The paper market, where banks and traders exchange contracts representing silver they may or may not actually possess, has completely disconnected from physical reality. You can buy a contract saying you own 5,000 ounces of silver with a few clicks on a trading platform, but try getting that actual metal delivered to your doorstep and suddenly everyone starts making excuses. The contract is easy, the silver is not. Now let's talk about what happens when that Chinese export door slams shut in 4 days. China isn't just a player in the silver market, they're the linchpin. Between their domestic mining operations and their role as a major refining hub, Chinese supply routes touch most of the silver that moves through Asia and eventually finds its way into everything from solar panels to smartphones to the electronics in your car. When those 80-ton minimum production requirements and $30 million credit lines kick in, we're not just talking about a few small miners getting shut out. We're talking about a complete restructuring of who can even participate in exporting this critical metal. The Federal Reserve hasn't made any public statements about silver markets, but you can bet they're watching. When any commodity moves 10% overnight, it sends ripples through currency markets, through commodity-linked bonds, through the derivatives that banks use to hedge their positions. And when that commodity happens to be essential for solar energy production, electronics manufacturing, and increasingly important in our transition to renewable energy, those ripples become waves. According to World Gold Council data on precious metals flows, the Chinese controls represent the single largest structural change to commodity supply chains since the pandemic disrupted global shipping. But unlike pandemic disruptions that eventually normalized, these export controls aren't temporary. They're policy. They're intentional. And they're designed to keep Chinese silver inside China, feeding their domestic solar panel industry and their electronics manufacturing base while the rest of us scramble for supply. You want to know who's really paying attention? Look at the industrial buyers. The companies that actually need physical silver to manufacture products aren't waiting around to see what happens on January 1st. They're locking in supply now, paying whatever premiums necessary, and quietly securing multi-year contracts directly with miners. These aren't speculators betting on price movements. These are executives who know their production lines will literally stop if they can't source silver next quarter. The overnight spike to $79.31 wasn't the beginning of this story. It was the market finally waking up to reality. For months, the warning signs were building, COMEX inventories declining every week, premiums widening at physical dealers, delivery delays stretching longer, and absolutely no one in the industry could explain where all the metal was going. Now we know. It was being drained systematically, pulled out of public markets and into private hands, warehoused by companies that saw this Chinese deadline on the calendar and did the math. What we're watching unfold is a supply shock in slow motion, except the slow motion part just ended. That 10.2% jump overnight was the market hitting the panic button. Traders who had been shorting silver, betting prices would fall, suddenly realized they might have to actually deliver metal they don't have. Industrial buyers who had been putting off purchases just saw their window closing, and investors who thought silver was just another commodity to trade suddenly understood they're looking at a genuine scarcity event. The question everyone should be asking isn't whether silver prices will keep rising. The question is, who gets access to physical metal when the Chinese export door closes in 4 days? And what happens to the paper contracts when everyone realizes you can't actually get delivery? We're about to find out if the largest commodity marketplace in our country can function when the underlying commodity becomes genuinely scarce. And based on those 3-week delivery delays and $12 premiums, the answer is already starting to reveal itself. The Fed hasn't had to intervene in silver markets since the Hunt brothers tried to corner the market in 1980. But this time, it's not speculators creating artificial scarcity. It's China implementing industrial policy that happens to control most of the world's silver supply. And you can't call Beijing to negotiate a bailout. 4 days until January 1st, 2026. The countdown is on. Let me show you the numbers that explain why that overnight spike wasn't a fluke. It was inevitable. According to the Silver Institute's 2025 annual report, our global silver market just recorded a deficit of 230 million ounces. Now, let me break down what that actually means in plain English. Total demand reached 1.24 billion ounces, while total supply from mines, recycling, and secondary sources could only deliver 1.01 billion ounces. We're consuming silver faster than we can dig it out of the ground, and that gap isn't small, it's a chasm. But here's where the story gets really interesting. The reason for this deficit isn't jewelry or investment coins like it used to be. Something fundamental shifted in 2025 that most people completely missed. Solar panel manufacturing consumed 64% more silver than the previous year. And for the first time in recorded history, photovoltaic production became the single largest source of silver demand on planet Earth. Solar panels just surpassed jewelry, which had held that crown for decades. Think about what that means for supply dynamics. When jewelry was the top demand source, manufacturers could adjust. Economic downturn, people buy fewer necklaces and rings, prices spike, jewelers can substitute or use less metal. But solar panels? You can't really substitute silver in photovoltaic cells without destroying efficiency. And with every major economy on Earth pushing renewable energy targets and climate commitments, that demand isn't optional anymore. It's policy-driven, and it's accelerating. The International Energy Agency projects that global solar installations will continue growing at 20% to 30% annually through 2030. Every single one of those panels needs silver. Every single one. We're watching industrial demand become completely inelastic right at the moment when China is about to choke off supply. The timing couldn't be worse for anyone who needs to buy silver, and it couldn't be better for anyone who already owns it. Now let's talk about who saw this coming and acted first. India imported 1,700 tons of silver in October 2025 alone. That's not a normal month. That's front-running on a national scale. Indian importers, manufacturers, and investors watched China prepare these export controls and made a calculated decision. Buy now before January 1st or pay double later. According to Indian Customs data, that October volume represented a 340% increase over the previous year's October figures. Someone in Mumbai did the math and decided it was worth tying up capital in silver rather than risk not having any. And India wasn't alone in the rush. Shanghai Futures Exchange reported that their silver warehouse stocks hit 10-year lows in late 2025, dropping to levels not seen since 2015. Chinese domestic buyers were pulling metal off the exchange, converting it to physical and storing it outside the system where export controls couldn't touch it. The Shanghai silver market effectively drained itself in anticipation of the policy change, leaving price discovery to happen elsewhere, mainly in New York and London, where the real scramble is just beginning. You want to see panic in slow motion? Look at what happened to the iShares Silver Trust, ticker symbol SLV, which is the largest silver-backed exchange-traded fund in the world. In a single week during December, SLV bled 56.41 tons of physical silver as institutional holders converted their paper positions into actual metal. That's not normal redemption activity, that's a run on the fund. Investors who owned shares representing silver suddenly decided they'd rather own the silver itself. Physical bars with serial numbers sitting in allocated storage where no counterparty risk exists. The SLV redemptions tell you everything you need to know about institutional confidence in paper markets right now. These aren't retail investors panicking. These are sophisticated funds, family offices, and portfolio managers who understand the difference between a claim on silver and actual possession. When the smart money starts converting paper to physical, everyone else should probably pay attention. But here's the part of this story that should really make you sit up straight. Multiple industry sources are reporting that Tesla, Microsoft, and Samsung have been negotiating off-market deals directly with silver mining companies for 2026 and 2027 production. We're not talking about buying futures contracts on an exchange where prices are transparent and everyone can see the trades. We're talking about executives flying to mining sites, sitting down with producers, and hammering out multi-year supply agreements at undisclosed premiums that bypass public markets entirely. Think about why that's happening. If you're Tesla and you need silver for every solar roof installation and every electrical component in your vehicles, you can't afford to wake up in 6 months and find out there's no silver available at any price. So you go directly to the source, you lock in production years in advance, and you pay whatever premium necessary to guarantee supply. You're not trying to get the best price. You're trying to ensure you can manufacture products, period. Microsoft needs silver for data center infrastructure and hardware manufacturing. Samsung uses it in smartphones, televisions, and practically every electronic device they produce. These companies aren't speculating on silver prices. They're securing the raw materials that keep their factories running. And the fact that they're willing to negotiate private deals rather than buy on open markets tells you they do entrust those markets to deliver physical metal when it's needed. What we're witnessing is the creation of a dark pool market in physical silver. Just like dark pool trading exists in stocks where big institutional orders happen away from public exchanges, we now have industrial silver buyers creating their own private marketplace that's draining visible supply from COMEX, LBMA, and other official venues. Every ton that gets locked up in a private 3-year supply agreement is a ton that won't be available to anyone else, regardless of price. The Silver Institute data shows that industrial fabrication demand, which includes electronics, solar, automotive, and other manufacturing, accounted for 61% of total silver demand in 2025. That's up from 52% just 3 years ago. We're watching silver transform from a monetary metal that people invest in into an industrial commodity that our entire modern economy depends on. And unlike monetary demand, which can ebb and flow with investor sentiment, industrial demand just keeps climbing because production lines don't stop running. Mining supply, meanwhile, is essentially flat. According to data from the World Bureau of Metal Statistics, global silver mine production increased by only 1.2% in 2025, despite prices rising throughout the year. Why? Because you can't just decide to dig more silver out of the ground. New mines take 7 to 10 years to develop from discovery to production. Existing mines are mostly producing at capacity, and many of the world's largest silver deposits are in regions with political instability, regulatory uncertainty, or infrastructure challenges that prevent rapid expansion. So we have demand growing at 5% to 10% annually, supply growing at barely 1%, and now China is about to cut off 60% to 70% of export availability. The math isn't complicated, it's brutal. Someone is going to go without silver in 2026, and it's probably going to be whoever waited the longest to secure supply. The Federal Reserve's quarterly report on commodity market stress indicators, released in November 2025, noted unusual tightness in industrial metals markets, with specific mention of silver market structure concerns. That's Fed speak for we're watching this closely because something doesn't look right. Central banks don't usually comment on individual commodity markets unless they're worried about broader financial stability implications. The fact that silver made it into their quarterly report should tell you this is not just a niche market issue. It's something that could ripple through the broader economy. Here's what happens when critical industrial inputs become scarce. Manufacturers either pay whatever it takes to get supply or they shut down production lines. There's no middle ground. And when manufacturers start bidding against each other for limited supply, prices don't rise linearly. They gap higher in sudden jumps, exactly like we saw on December 27th when silver jumped 10.2% overnight. Those private deals that Tesla, Microsoft, and Samsung are negotiating, they're not just about securing supply, they're about avoiding the price chaos that's about to hit open markets. By locking in production at fixed premiums today, these companies are essentially buying insurance against the supply shock they know is coming. They've done the same calculation everyone else should be doing. The cost of securing silver now, even at elevated prices, is cheaper than the cost of not having silver when you need it. The London Bullion Market Association, which sets standards for precious metals trading, reported in their December 2025 newsletter that good delivery silver bar premiums had reached their highest levels since 2011. Shanghai stocks at 10-year lows, SLV bleeding physical metal, India front-running with massive imports, tech giants negotiating off-market deals, COMEX inventories down 70% since 2020. Every single indicator is flashing the same warning. The physical silver market is running out of slack. And in 4 days, China turns off the supply tap. The deficit isn't theoretical anymore. It's here, it's measurable, and it's accelerating. Someone is going to learn a very expensive lesson about the difference between paper claims and physical possession. And based on what we're seeing in delivery delays, premiums, and institutional behavior, that lesson is about to be taught to a lot of people simultaneously. The question isn't whether there's a supply crisis coming. The question is who gets caught on the wrong side of it. Now, let's talk about where this price is actually going, because the overnight spike to 79.31 wasn't the destination, it was just the opening act. Robert Kiyosaki, the author of Rich Dad, Poor Dad, and someone who has been publicly bullish on precious metals for years, went on record forecasting $200 silver by the end of 2026. That's not a typo. $200 per ounce. Before you dismiss that as wild speculation from a permabull, let's look at what the technical analysts are seeing on their charts right now. Technical traders who follow Fibonacci extensions have identified 3 key resistance levels that silver needs to break through on its way higher. The first target sits at $85 per ounce, which represents the 1.618 Fibonacci extension from the 2020 low to the 2024 high. We're currently at $79, so that's less than 8% away, basically a couple of strong trading sessions. The second target lands at $96, which corresponds to the golden ratio extension, and happens to be right where silver topped out during the last major rally in 2011 before inflation adjustments. And then there's the big psychological level at $100 per ounce. Let me explain why $100 matters more than any mathematical formula or technical pattern. It's called unit bias, and it's one of the most powerful forces in retail investor psychology. When any asset hits a round number with that many zeros, something shifts in people's brains. Gold crossing $2,000 triggered a stampede of new buyers who had been sitting on the sidelines. Bitcoin breaking $100,000 brought in waves of retail money that had been waiting for confirmation. Silver at $100 will do the same thing, except the silver market is so much smaller than gold or crypto that when retail investors show up all at once, the available supply gets overwhelmed instantly. Think about how this plays out in real time. Your neighbor, who's been hearing about silver on YouTube, suddenly sees the price hit 3 digits. Your coworker, who's got $50,000 sitting in a money market account, decides maybe he should own some real assets. Your brother-in-law, who missed the gold rally, doesn't want to miss this one. They all try to buy at the same time, and they all discover what we've been talking about. 3-week delivery delays, massive premiums, and dealers who can't guarantee when they'll have product in stock. That's when retail panic buying begins. That's when prices don't just rise, they explode. But we don't even need to wait for $100 to see serious volatility. We need to talk about what happens in 4 days when that Chinese export door actually slams shut. January 1st, 2026 falls on a Wednesday, but here's what most people don't realize. Commodity markets in Asia open Sunday night, US Eastern Time. That's when Shanghai starts trading for their Monday morning session. And that Sunday night open is when Western buyers are going to wake up to a very different reality. Chinese exporters who can still legally ship silver under the old rules have exactly 4 days to fulfill their final contracts. According to shipping data from logistics companies that handle precious metals, there's been a rush of expedited shipments leaving Chinese ports in the last 2 weeks of December. Everyone who had outstanding orders is trying to get their metal across the border before the clock strikes midnight on New Year's Eve. But once that deadline passes, the flow stops. Completely. What happens Sunday night when markets reopen and traders realize the Chinese supply tap just turned off? Based on how commodity markets behave during genuine supply shocks, we're likely looking at a gap-up open. That means silver could close Friday afternoon at $79. And when trading resumes Sunday night, the first trade might be $85 or $88 or higher, depending on how many buyers are waiting and how few sellers show up. There would be a gradual climb. There will be a gap in the price chart where no trades happened because no one was willing to sell at those levels. The last time we saw a comparable supply shock in precious metals was 1979 and 1980, when the Hunt brothers were attempting to corner the silver market. Silver went from 6 in January 1979 to 48 by January 1980, an 8-fold increase in 12 months. The circumstances are different this time, but the market structure issue is actually worse. Back then, the Hunts were artificially creating scarcity through market manipulation. This time, we have genuine industrial demand overwhelming available supply, while a major exporting nation implements policy that cuts off the majority of international flow. You can break a corner. You can't break industrial demand and national policy. The Federal Reserve eventually intervened in 1980 by changing margin requirements and making it prohibitively expensive to hold silver futures contracts, which collapsed the Hunt brothers' position. But that worked because the scarcity was artificial. What's the Fed supposed to do this time? Call up Beijing and ask them politely to change their export policy? Margin requirement changes won't create physical silver that doesn't exist. The Fed's playbook from 1980 doesn't work when the shortage is real. Now let's talk about what's happening in mining stocks, because this is where the takeover game starts getting very interesting. Any silver mining company with production capacity over 80 tons annually and proven reserves just became a strategic asset. Why? Because they're one of the few entities that will still be able to export silver from China. And they're one of the limited sources of new supply anywhere in the world. According to investment banker research reports circulating in December, several mid-tier silver developers are already receiving informal inquiries from major mining companies about potential acquisitions. The big producers are facing a problem they've been ignoring for years: reserve depletion. Their existing mines are producing at capacity, but ore grades are declining and mine life is shortening. They need to replace reserves, and the easiest way to do that isn't exploration, it's acquisition. Buy a company that already has proven reserves and permitted projects, especially if those projects can produce 80 plus tons annually and have the financial backing to meet China's export requirements. We're likely to see a wave of takeover offers in Q1 2026 as major producers realize the strategic value of development stage assets they previously considered too small or too risky. For investors who bought mining stocks in 2023 and 2024 when silver was trading in the 20s and 30s, this creates an interesting situation. Do you hold for a potential takeover premium that could be 50% to 100% above current prices? Or do you sell into strength as the stocks rally alongside physical silver? There's no wrong answer, but there is a timing component. Takeover offers usually come after initial rallies when the acquiring company can justify a premium price to their own shareholders. The sweet spot is probably somewhere between $90 and $120 silver when majors start getting desperate for reserves. But here's where the situation gets really binary for people who own physical silver. You're holding metal that's rising in value, premiums over spot are expanding, and demand is accelerating. The question you have to answer is this: do you hold through $100, through $120, possibly through $150 or higher? Or do you sell into what might be the last truly liquid market before exchanges start implementing liquidation-only rules? Let me explain what liquidation only means, because this happened in other commodities during extreme volatility. When a market gets too one-sided with everyone trying to buy and no one willing to sell, exchanges can change their rules to only allow position closures, not new position openings. That means if you own silver, you can sell. But if you don't own silver, you can't buy. It's a circuit breaker designed to prevent market dislocations from turning into complete chaos. But if you're holding physical metal when that happens, you suddenly find yourself in a situation where the number of potential buyers just got restricted and your ability to exit at your preferred price becomes uncertain. CME Group, which operates COMEX, has broad authority under their rulebook to implement special margin requirements, position limits, and trading restrictions during periods of extreme volatility or delivery stress. They've done it before in other markets. They'll do it again if silver becomes too disorderly. And if you're sitting on physical metal when those rules get implemented, you better hope you're okay holding for the long term, because your exit window might close faster than you expect. The strategic calculation for physical holders comes down to personal circumstances and risk tolerance. If you bought silver as insurance against currency debasement and system instability, then $200 silver doesn't change your thesis. You hold through the volatility. If you bought silver as a speculation on supply-demand imbalance, then you need to decide what price target justifies taking profits before market structure changes make exits more complicated. There's no universal right answer, but there is a deadline for making the decision. The moment liquidity dries up and bid-ask spreads widen to the point where you're giving back 10% or 15% just to find a buyer. According to Precious Metals, dealers who've been in this business for decades were already seeing early signs of that liquidity deterioration. Spreads between bid and ask prices have widened from typical levels around 3% to 5% to current levels approaching 7% to 8% for retail-sized transactions. Wholesale market spreads on good delivery bars have widened as well, though not as dramatically. What that tells you is there's already hesitation among market makers to provide liquidity. They're worried about getting stuck with inventory they can't easily move, so they're widening spreads to compensate for risk. As we approach and pass $100, those spreads could widen further. The Commodity Futures Trading Commission releases weekly commitment of traders reports that show positioning by different market participants. The most recent data from late December shows commercial hedgers, the miners, refiners, and industrial users who actually deal in physical silver, holding their largest net short position in over a year. That's not bearish. That's actually the opposite. It means the people who produce and use silver have sold forward their anticipated production because they think prices are going higher and they want to lock in elevated prices now. When commercials are aggressively short, it usually means they expect significant upside ahead. Large speculators and managed money funds, meanwhile, have added to long positions but aren't yet anywhere near the extreme level seen in 2011 or 2020. There's still room for speculative money to pile into silver futures before we hit positioning extremes that signal a potential top. Combine that with the physical market tightness we've discussed, and you have a setup where both the fundamental supply-demand picture and the technical positioning support significantly higher prices. Gold hit $2,800 per ounce in December 2025, and most commodities analysts agree that the historical gold-to-silver ratio should normalize somewhere between 40.1 and 60.1 during precious metals bull markets. Right now, with gold at $2,800 and silver at $79, we are looking at a ratio of about 35:1. That's already compressed from the 80.1 or 90.1 levels we saw a few years ago. But if gold stays elevated and silver continues catching up, a 50.1 ratio would put silver at $56, which we've already blown past. A 40.1 ratio would put silver at 70. We're past that too. A 30.1 ratio, which we briefly touched during the 2011 peak, would put silver at $93. The mathematical relationships that typically govern precious metals markets are breaking down. Because silver is not behaving like just a monetary metal anymore, it's behaving like an industrial commodity experiencing a genuine supply shock. And industrial commodities during supply shocks don't respect historical price ratios. They trade based on who needs them more desperately and who's willing to pay to secure supply. So here's what we're looking at as we count down these final days before January 1st. We have technical targets at $85, $96, and $100. We have a prominent investor forecasting $200 by year-end 2026. We have a hard deadline in 4 days that will cut off the majority of global supply. We have Asian markets opening Sunday night, where Western buyers will discover that reality. We have mining stocks becoming takeover targets. We have physical holders facing a binary decision about when to exit. And we have exchanges preparing to potentially restrict trading if volatility gets out of hand. The mechanism that was hidden for months, the systematic draining of COMEX inventories, the front-running by India, the dark pool deals by tech giants, the Chinese export controls everyone knew were coming but chose to ignore, is now fully revealed. The emergency isn't hypothetical anymore. It's happening in real time. And the people who understand what January 1st means are the ones positioning themselves accordingly right now, this weekend, while there's still time to act. Silver at $79 wasn't the emergency. Silver at $79 was the market finally pricing in that the emergency is here. What comes next depends on how many people realize that simultaneously and what they do about it. Because in 4 days, the supply equation changes permanently, and everyone who waited to see what would happen gets to find out the expensive way. The countdown clock is almost at zero. The question isn't whether silver keeps rising. The question is whether you're positioned for what happens when that Chinese export door closes and the scramble for physical metal becomes the only trade that matters. The smart money already made that decision weeks ago. The rest of us have 4 days to figure it out.